Hello and welcome to our monetary policy curtain raiser. It is baptism by fire for the new Reserve Bank governor as he goes ahead to present his maiden monetary policy. The budget was kind, yes, in terms of a lower deficit, but President Trump has created a perfect storm in the global currency markets, including for India. So exactly what should the Reserve Bank and the MPC do? Can you cut when there is a global storm in terms of EM currencies? That's the question for which we need answer. And as always, the Citizens Monetary Policy Committee of CNBC TV18 meets on the eve of the RBI MPC to deliberate on what should be the issues and how to look at them. I have with me Chairman of our committee, Dr. Pronab, and members Soumya Kanti Ghosh of State Bank of India, Sajjid Chinoy of JPMorgan, Samiran Chakraborty of Citi India, and Sonal Varma of Nomura. Gentlemen and Sonal, thank you very much indeed for your time. It's a very, very crucial policy, as I said. Sajjid, it is the global churn that is going to worry us most. Just outline the, the announcements that have come from the US. What does it do to global inflation and our own inflation expectations? And what does it do to global growth?
Thank you, Latha. I think the global economy is getting more precarious by the day. 2024 was characterized by US exceptionalism, where US growth was very resilient, and that meant a stronger dollar and higher US rates. And both of those things put pressure on emerging market currencies, constraining their space and their ability to respond. What we're seeing now is the onset of the much feared trade war. The US has put on tariffs on Canada, Mexico, China. Those countries have begun to retaliate. So this trade war could get ugly very quickly. And the question really is, number one, this is going to depress global growth. I think the lesson from the first trade war in 2018 was very clear. It was the uncertainty of the trade war that depressed global business sentiment and global capex intentions. And it was very clear in the data in 2018 and 2019. So I think we should brace for a global environment with more growth headwinds, where exports will most likely, take a hit. The difficult question is whether the trade war is going to exacerbate or undermine US exceptionalism, because there is a scenario in which global growth gets hit, but US growth gets hit less because that country has offsets, easier fiscal policy and more deregulation. Now, that's the worst of all worlds for emerging markets, because you are living with lower global growth and therefore lower export growth. But your ability to respond to lower growth is compromised by the fact that US exceptionalism means the dollar remains elevated. Today's dollar rate is almost at 20-year highs, and US rates remain elevated. And then you're in this bind where you want to respond to a more hostile global environment in terms of weaker growth, but you're unable to do so completely.
Yeah, I take your point.
That's the dilemma that these economies face.
Yeah, I take your point entirely, which brings you to the classical question, which the MPC will have to address, Samiran. Can you really respond with rate cuts and growth stimuli in a situation of, tension on the currency?
3 points here. The first point is that when there is so much of global growth uncertainty, we have to think of what we can do for our domestic growth. And from that perspective, whatever the budget is trying to do or whatever the MPC is trying to do will be very much focused on trying to get the domestic growth up. The second point is that to start with, our currency was somewhat overvalued by standard metrics of 40-country trade-weighted RER, etc. So part of the depreciation that we are seeing might actually be a good thing, and to some extent might be also giving that little bit stimulus that exchange rate depreciation gives to the overall growth outlook. So some part of the depreciation might not actually be a bad thing at all. And the third issue is that there is, at least our view is that our capital flows are more growth sensitive than interest rate sensitive. So it is somewhat unorthodox view, but if the governor, RBI, MPC, they believe that they can spur growth expectations at this juncture by a somewhat easier monetary policy in tandem with the fiscal consumption stimulus that we have seen, then it might just kickstart the capital flows into India, which are more growth sensitive, and to some extent that can stabilize the currency as well. So to me, the interest rate cut is not necessarily an antithesis to the currency story.
No, actually, you're right. Even in the last few days, we have seen inflation, we are seeing actually debt flows continuing somewhat. It's only equity that's hurt. If interest rate differential was such an issue, we should not be seeing debt flows. But, you know, your growth issue is more important. Is growth really under so much threat? Dr. Sen, that question to you actually. The budget is expected to have boosted consumption since it has cut taxes so generously. So what's your assessment of growth per se, domestically speaking? Do you think growth has a better chance now in FY26?
That's not clear, Latha, because they've given with one hand and taken away with another. And the way it's been done, I find a little disturbing, particularly for the consumption story. Yes. Because what they've done in effect is given a break to the middle class. But they have reduced the outlay on education, health, social services of various kinds, which essentially affect the lifestyle of the poorer, which is much the larger number. And we do not know whether these people will be then forced to, in a sense, rejig their consumption basket. And the net effect may well turn out to be negative.
Okay, well, yeah, there is, of course, not much for the bottom of the pyramid if you look at it that way. But let me also get, some inflation questions out of the way. Sonal, how would you look at inflation now? Is there a possibility that with so much of, uncertainty and supply chain disruptions likely, inflation may surprise negative? Or is inflation definitely headed towards 4.2 or something, which the Reserve Bank is forecasting?
For now, Latha, it looks like we are headed in the 4.5% range. I mean, if you look at India's CPI basket, bulk of it is actually non-tradable. So food services play a much bigger role. The pass-through from currency weakness, our estimate is a 5% depreciation leads to about a 30 basis point impact on headline inflation. And we are in a soft demand environment. So really the spillover to consumers will be less. There's a bigger risk that firms see pressure on their corporate profit margins. Food in particular, we've seen a positive surprise. The two items that were holding inflation up, which is vegetables and pulses, are sequentially falling. And the big run-up in edible oil prices, the pace of increase there is also slowing down. So we are seeing some positive news on food inflation. Rabi prospects look a bit uncertain, but on the whole, I would say the decline in headline inflation and core, which is very well anchored, soft demand conditions mean that headline inflation, which was at 5.2% in December, should come down to below 4.5%, in fact, in January itself, and then stay in this 4.5% range through the next 12 months. So the inflation outlook does look a lot more favorable.
Okay, so that means the Reserve Bank has more elbow room. Well, let me get a little more on growth, and then I come to the all-important steps, the liquidity steps in particular. Soumya, if you can wrap up the growth argument, how will a lower currency at 87.30 or 87.50 help growth? Again, there is the budget. Are we in a position to expect better growth in FY26 than in 25?
Yeah, thank you, Latha. I think regarding before I answer the question on growth, the point on exchange rate you mentioned, I think exchange rate movements in India, as we see that the exchange rate there has been again a significant depression in the value of the exchange rate because of the measures of President Trump. But my sense is that also a large part of the currency movement is also growth accretive in the Indian context. if you actually do an empirical analysis, you will find that apart from the dollar index movement, which determines the direction of the value of the rupee, a large part of the rupee is also determined by the factors which are positive to growth. So from that point of view, I think these current movements in exchange rate, we should understand the global idiosyncrasies. And the best thing to happen at this point of time is basically look into the growth prospects. As of now, if you ask me about the growth prospects for the next fiscal year, the numbers are actually not significantly different from what you will get in the current fiscal year, which is basically FY26. So my sense is that I think it will be better if we look into the perspective from a growth one rather than purely from an exchange rate perspective that what one may think of.
Okay. So short point, you're saying that next year's growth will be as good as this year's or as bad as. So something like 6.3, 6.4.
Yeah, it should be similar to this year's growth rate. So from that point of view, I think there could be, it is required that there could be policy interventions which could actually spark growth.